Hello everybody, welcome back to Valuation Investing, and today in this video I'm going to be ranking the most popular semiconductor stocks based on their valuation. And the reason I decided to do this is because as AI has been taking over the world, a bunch of products have needed to have chips in which the demand for these chips have increased exponentially in the past few years. So I decided to rank these most popular semiconductor stocks, which the companies I'm going to be analyzing is Nvidia, Broadcom, Taiwan Semiconductor, ASML, AMD, Applied Materials, ARM, and Intel. So I'm going to be analyzing these stocks today and determining where I should rank these companies based on the valuation that I get with an intrinsic value calculator. So the first company I'm going to be looking at is Nvidia. And if you take a look at Nvidia, the first thing I have to do is make assumptions for the revenue growth rate over the next 10 years. So if we go ahead and take a look at analyst expectations, they expect them to actually grow at about 28% in the next 5 years. However, I think that's a little bit high, especially for the next 10 years. So going for the revenue growth rate, I believe Nvidia will grow at about 15% on a conservative basis. I'm going to be a little bit conservative with these assumptions to ensure a margin of safety with our investment. Now for the net profit margin. If we go ahead and take a look at Nvidia's net profit margin over the past few years, we can see it's been increasing very fast. And as of right now, it's actually about 51%. I don't think that Nvidia's profit margin is going to be that high in the next 10 years. And the reason for that is because I believe Nvidia is going to run into more competitiveness in which they're going to have to lower their prices. As of right now, they have such a high profit margin due to the huge demand for their chips, and they're basically the only company that can really have these chips made for AI infrastructure, in which they can have a high pricing power. So I think that this is going to decline slightly over time. While I don't think it's going to decline a lot, I think it will go to about a 45% net profit margin. Now for the PE ratio. The stock market trades at anywhere from 20 to 25 PE ratio. So I actually think Nvidia does deserve a premium to the market since Nvidia is a higher quality company and they're growing at a faster rate. So I think they deserve about a 28 PE ratio. And with that being said, I get a fair value price for Nvidia at $130 per share. And if you bought this today, I think you can make about a 9% return each year. So with that being said, if we go to our rankings, I think Nvidia right now is actually at a fair valued price. And the reason for that is because normally for a fair value price, I think of anywhere from 9 to 10% return on your investment is a fair value. So I think Nvidia is at its fair value today. Now the next company I'm going to be looking at is Broadcom, in which Broadcom has had huge gains in its stock price similar to Nvidia and is worth over $1 trillion as of right now. So Broadcom has had some recent acquisitions of a company such as VMware and has really been growing over time, in which I actually owned Broadcom before, in which I've actually sold out of my position. But if we go ahead and take a look in the intrinsic value calculator, I have to once again look at the revenue growth rate for Broadcom. Looking at the analyst expectations, they're expected to grow at about a 25.7% rate over the next 5 years. But taking a look at the revenue growth rate over time, we can see they've been growing at a pretty decent rate. And they've been growing at about 20% in the past few years. So this is pretty fast from Broadcom. And once again, I think a very fair revenue growth rate is 15% for Broadcom. Now for the net profit margin. If we take a look at the net profit margin for Broadcom, we can see it was increasing at a pretty good rate in the 2020s. Until they acquired VMware, we saw a big decrease in net profit margin. However, I do think that they can get near that net profit margin of 40% once again. Even though they're at a 22% net profit margin right now, I think they're going to get back into the groove of things and get back up near 40%. I don't think it's going to necessarily be at 40%, but I think 35% is fair for Broadcom. Now taking a look at the terminal PE ratio. Once again, I think this is a higher quality company compared to the market. However, I think they're a slightly lower quality than Nvidia just because not as much demand for their chips and stuff like that. So I'm going to put a terminal PE ratio of 26, actually 27. I think that's pretty fair. And with that being said, I get a fair value price of $193 for Broadcom, in which I think if you bought this today, you can make about a 7.7% return on your investment each year. And with that being said, I'm going to put Broadcom into the overvalued category. I think that you won't be making very good returns on this company. You're probably going to slightly underperform the market, but only with my assumptions I'm making because I'm going to be slightly conservative on these assumptions. But nonetheless, I think you're going to make slightly underperforming the market. Now, the next company I'm going to be looking at is Taiwan Semiconductor, in which Taiwan Semiconductor actually supplies the chips to the companies such as Nvidia and Broadcom. So they are the beginning manufacturer of these chips. So if you go over to the intrinsic value calculator for Taiwan Semiconductor, I'm going to do the revenue growth rate for Taiwan Semiconductor. If we look over the past 5 years, they've been growing at about a 22% rate. But if we take a look at analyst expectations, it's actually lower than the first two companies of Nvidia and Broadcom, where they're expected to grow about 19.5%. So with that being said, I think a fair revenue growth rate for Taiwan Semiconductor is probably 13% in the next 10 years. So I think that's a pretty fair area. Now for the net profit margin. Taking a look right here for the net profit margin, it's been pretty consistent. Compared to these other companies, Nvidia and Broadcom, Taiwan Semiconductor is a much more consistent and stable company. So I think it's going to stay right around 40%. Now for the terminal PE ratio. I think a fair terminal PE ratio, it's been right about 20 to 25. So I think a terminal PE ratio of 25 is fair because I think Taiwan Semiconductor is very similar to the market. So with that being said, I somehow get a fair value price of $62 for Taiwan Semiconductor. So I don't know if this is necessarily accurate for Taiwan Semiconductor. I don't think that you're going to make this low of a return on Taiwan Semiconductor. This might be a fluke in the intrinsic value calculation, but let's take a look at the earnings growth instead for Taiwan Semiconductor. Say they grow about 20% and then 25 P ratio, I still get about a very low return. So I think actually Taiwan Semiconductor right now is a sell now, even though I don't really believe that it's going to do this much worse than the market. With my intrinsic value calculator, it does show that it's actually going to grow at a very low rate. So that's pretty interesting. But now the next semiconductor stock I'm going to look at is ASML. And I actually own ASML and it's actually gone up a little bit. So I would like to see if I should be buying more at these prices, in which ASML supplies all these chip companies with machines called lithography machines, in which it imprints the patterns onto the chips, in which this is the only company to make EUV lithography machines, and they cost over $400 million to purchase, in which they also service this machine. So every semiconductor company basically has to buy these machines. So they have a really good moat, and which is why I actually own them. Taking a look at the analyst expectations for ASML's earnings growth, we can see that they're expected to grow about 17.4% over the next 5 years, in which this is annually. So I think a fair revenue growth rate for ASML for the next 10 years is actually about 12%. So I definitely think it's going to be slightly lower than the other companies we've analyzed, but I think 12% is pretty reasonable. Now the net profit margin. The net profit margin has slightly increased over time from 19% in 2013 all the way to 27% in 2024. And right now, I think it's actually going to stay at about that 27 to 30% net profit margin. So I think a fair net profit margin is 28%. Now for the terminal P ratio. Even though this company's revenue growth rate isn't going to be insanely fast, I do think that they have a large moat, in which I think a fair terminal P ratio is actually 27, similar to Broadcom. And with that being said, I get a forecasted return of about 14%, in which I think it's still a pretty good buy. Me personally, I like to make about 15% on my investments, so I have an average price in the 600s, but right now it still doesn't look bad to buy today. And I actually think right now, I would say it is a buy now in these market conditions. And I think ASML, you can make almost 15% return on this company each year. So far, ASML looks like the best value right now. And the next company I'm going to be looking at is AMD, which is known as the son of Nvidia, basically, because over time, Nvidia's just outgrown AMD, in which AMD has started to take the backseat to Nvidia, in which it just shows that AMD isn't as much of a competitor to Nvidia, in which their chips are starting to slowly get a wider gap between the quality of Nvidia and AMD. So I'm going to take a look at AMD right now. Taking a look at AMD, we're going to look at the earnings per share expected by analysts, in which they expect them to grow actually about 24.5%. So slightly slower than both Broadcom and Nvidia, but once again faster than ASML and Taiwan Semiconductor. So I'm going to think a fair revenue growth rate for AMD is about 13 or 14%. I think 14% is pretty fair, in which over the past 10 years, they've averaged about a 17% revenue growth rate. Now, looking at the net profit margin, which is actually pretty interesting, they have a very low net profit margin, in which it's actually been around 5% over the past few years. We saw a huge leap in 2020, but I don't think that's sustainable. But I do think that they could actually get this up to, say, 10% net profit margin. Now, for the terminal PE ratio, I think a fair terminal PE ratio, once again, like all these other companies, I think a 25 P ratio. I don't think it's a high quality company when compared to Nvidia, but I do think they deserve about market average or higher. So 25 P ratio. With that being said, I get a 3.2% annual return rate on AMD if you bought it today. So I think right now AMD is actually a sell now. So right now, I don't think AMD you should be buying today. While it is a sell now, I don't necessarily, if you own this company at a good price, I definitely wouldn't sell the company right now, but I would definitely hold this company and definitely not add any to your position right now, since we saw a huge rise in stock price over the past month or so. The next company I'm going to be looking at is Applied Materials, in which I've actually been interested in this company, and I think Applied Materials, although it is probably the slowest growing company, I think its valuation is pretty decent, but maybe not today because I've seen the stock price has been going up pretty much a lot. So I don't know if it's at a good value today, but that's why we're doing this video. So looking at analyst expectations for Applied Materials, they're expected to grow at about a 9.5% rate. And if we go over here, the revenue growth rate over the past 10 and 5 years, it's averaged about 12 and 13%. But it has been slowing down a lot over the past few years, in which this company is kind of similar to ASML, but instead of focusing on one machine, they make a whole bunch of machines that are for semiconductor companies. And they don't make lithography machines, but they're a diversified machine maker basically for chip companies. So with that being said, I think a fair revenue growth rate for Applied Materials is 7%. Now for the net profit margin. The net profit margin has been staying right at about 25%, so I think 25% is very reasonable. Now for the terminal PE ratio, I think a good terminal PE ratio for Applied Materials is actually 22. I think they deserve a slightly undervaluation compared to the market, but I don't think they deserve a very big discount. So 22 P ratio, which is right near the market average or slightly low. So with that being said, I get a fair value price of $187 per share and a forecasted return of about 11% each year. So with that being said, I think Applied Materials right now is actually an undervalued company, in which I think undervalued is anywhere from 11 to like 13% annual return, in which buy now I think is greater than 13% return. So right now we have a pretty diversified ranking tier list right here. But now we're going to take a look at ARM Holdings, in which Nvidia is a pretty big investor in this company, and it has been going insane recently, and I think this company is pretty overvalued, but let's go ahead and take a look at the intrinsic value calculator. Taking a look at analyst expectations, ARM's supposed to grow at about 22% over the next 5 years, which I'm actually surprised that it's not faster than that. And I think that's actually pretty slow. So looking at the intrinsic value calculator, I think a fair revenue growth rate is probably about 14% for ARM, in which it's been only growing at about 20%, and it's actually slower than Nvidia, which is very surprising, especially with the huge valuation of this company. I don't know about this one. Now looking at the net profit margin, I think a fair net profit margin is actually at 25%. I think their net profit margin will grow over time a little bit more because this is a smaller company and not as mature, and I think they're going to increase this higher. Now for the terminal P ratio. I think a good terminal P ratio, like most of these companies, is about 25. And with that being said, I think you would get a negative return on this company if you bought this today. And I just think this company is a sell now. I just believe this company you shouldn't be buying today because the company's actually a slow growing company compared to most of these other semiconductor stocks. And yet the company's at a valuation that's at about 200 P ratio, which is almost 10 times most of these companies. So I don't know why you're going to be paying so much for ARM in which they're not even growing that fast. Now, the final semiconductor stock I'm going to be looking at is Intel, in which everybody says Intel is dying, and Nvidia and AMD is basically taking over the business, in which I definitely do believe that. And when we look at analyst expectations, I'm actually surprised that they're expected to grow at about 10% over the next 5 years. However, this is the earnings per share, so keep that in mind, which I think they're expecting the profit margin to increase, but potentially the revenue growth rate will decrease over time. But looking at the intrinsic value calculator, we can see it's been basically negative revenue growth rate, but in the past year, it's actually flat. So I think a fair revenue growth rate for Intel is probably like 4%. I think they'll grow slightly faster than inflation, but I don't see them growing any faster than 4%. So I think that's pretty fair. And now for the net profit margin. I think a fair net profit margin is actually about, I don't know. This is a tough one here, guys. I think 10%. I think Intel is just a pretty bad company, and I wouldn't even invest. Even if this said we can make a big return, it's just doesn't look good. The financial health of this company looks terrible. Now, the terminal P ratio, I think a good P ratio is 15. Just because the slow growth of Intel, I don't see this company doing well over time. And with that being said, I think if you bought this today, you would make about a 7.5% return over time. And this is being pretty bullish on the stock. But nonetheless, I think right now Intel looks overvalued. So thank you guys for watching this video. With that being said, I think ASML is a buy now. I think Applied Materials looks pretty undervalued. Nvidia looks fair valued. Two companies look overvalued, in which Broadcom and Intel look pretty overvalued. And sell now, I have Taiwan Semiconductor, AMD, and ARM. While I don't necessarily think Taiwan Semiconductor is a sell now, but the intrinsic value calculator does say that, in which I'd probably say Taiwan Semiconductor is overvalued, but I don't think you should be selling now. So thank you guys for watching this video. Please subscribe, hit the like button, comment down below. Thank you.